Before a transaction or event can be recognized in the financial statements, there are 4 key decision areas for the accountant to review. The first relates to whether the item meets the definition of one or more of the 5 financial statement elements. With double entry accounting, there are often 2 elements involved in a transaction. The 5 financial statement elements are assets, liabilities, equity, incomes, and expenses. Each has a set definition which is included in the conceptual framework. The accountant then decides if the recognition criteria, based on probability and reliable measurement, are satisfied. We then decide how to appropriately measure the item. For example, if the item is an asset, we need to decide if it should be measured at cost or in terms of the value-based measurement. And if we decide on a value-based measurement, further decisions need to be made in terms of which specific value-based measurement should we use. For example, should it be fair value, net realizable value, value in use, or some other measure? And finally, we decide how to disclose and present the item such that it is relevant while also providing faithful representation. Let's look at a basic example. The secretary of ABC Limited purchased a pencil for $3 using the company's petty cash. There is a decrease in assets as petty cash has been used to buy the pencil. As the pencil is used and sharpened, it gets depleted and used up, so it is an outflow of resources that leads to a decrease in equity. Thus, the pencil is a consumable store, and this would be recognized as an expense in the income statement. The recognition criteria are satisfied as the payment for the pencil meets the probability criterion, as it has already occurred, and it can be reliably measured by reference to the receipt. The best measurement would be to record the pencil at its $3 cost. In terms of relevant presentation, users of the financial statements are not likely to base decisions on a $3 pencil, so this would be aggregated in the stationery account. To faithfully represent the pencil in the financial statements as an insignificant item that is depleted when used, the pencil may be further aggregated into general expenses or consumable stores. To recap, we can see that a conceptual framework provides us with a systematic process to record transactions. We first establish that the element definitions are met and the recognition criteria satisfied. Reliable measurement and appropriate presentation that faithfully represents the situation while remaining relevant are the final steps in the process.